Good morning, ladies and gentlemen. Well, I haven't got very much new to say this week because last week was a complete non-event. Nothing happened. But we do have some very interesting stuff happening this week, which is the supply of 3s, 10s, and 30s, the CPI number, which is going to be the last number that the Fed really looks at before it decides what it's going to do in September, the FOMC meeting after next week. And we do have the ECB decision, and I think it's quite likely, well, it's a 50-50 that they might raise, but if they don't raise, that'll tell us something as well. In any case, the model score is still positive. It's still 71, which is the highest bin, as it were, that still belongs in. So still looking for growth stocks and to avoid bonds. And it's not really on the cusp of changing. The good news is that we are nearly done with testing and perfecting everything on the site. So within a week or so, you will have your logins and you can go and play with it. One thing that is interesting to me is that in QT, and where we are now in QT, I think it's very unlikely that the model is going to give any sustained wrong risk-off signals. Because with this QT ongoing and the huge supply in treasuries ongoing, very, very difficult that when the market goes into risk off, it doesn't stay in risk off for a long time. As you can see from this chart, every time it goes in risk off, the median is down 2.75% and the mean is down 6.5%. But this is when QT started, and we've only had one risk off and one slightly false signal in risk off, which really is only because of the way the moving averages work, which is basically a nothing, a 2.7 drawdown as opposed to a over 10% gain. So I'm really looking forward to seeing what equities do over the next few weeks. We're still very, very far away from risk off, but when we do go into risk off, I think it's going to be a very deep risk off because of the ongoing QT. I think the whole way that the market trades has changed, because throughout 2010 out to 2020-21, we've basically had there is no alternative to stocks, that kind of environment with QE going on. And now that we have QT and a permanence of QT for another at least a year, I would have thought, it's going to be very, very interesting to see how the model works. But in any case, let's get into bonds and see what they're likely to do next week and what opportunities we might have. Well, as you've all noticed last week, absolutely nothing really happened. What did the 2-year close at? Something like 6-7 basis points higher than the previous one. In any case, it's quite obvious that here around 475 is the zero probability of a hike by the Fed. And here we are at, 40-50% probability, and that is 100% probability at 527. I am far more bullish of the shorter end than I am of the longer end. I am in the steepening camp. Not that it happened last week, but I just think that once you start getting into the fives, the odds are that you get a reversal back into the fours. Now, why will that be? Well, I think the Fed is very close to being done. They would probably like to be done. Will the data support that? Who knows? But unless we start getting some kind of reacceleration in CPI, which I don't really expect, even though oil has been so strong and energy has been strong, I expect the numbers to be in line with what the market expects and what the Fed projects. And therefore, I think the pressure on the short end, once you start getting to new highs and stopping people out, is just going to dissipate. And then the first bad number you get on the economy, it goes back down into the 480s. So that is the way I'm seeing the current situation with the Fed. And that is coloring what I think are the opportunities. I think the opportunities are to buy twos and threes if you get breaks above these previous highs at 512, because I think they're unsustainable. And much in the same way, I think the opportunity is to probably sell 30s if they get down towards this 419 area. I think the yield curve will have a natural tendency to disinvert from now on. The one I'm most interested in is actually threes, because I think that if threes spike for any reason to around this 490 area, I think it's very difficult to see that the Fed is not going to achieve its inflation target. All we're arguing about is if it's going to achieve it in the course of the latter part of 2024 or the middle of 2025. I don't think we are really arguing anymore whether they're going to achieve it or not. What we are arguing about is the speed at which they achieve it. And I'm in the camp at the moment that says that it's probably going to take slightly longer than they think or hope for, in which case they will start easing at some stage next year, but it'll be probably less than the market expects. So the only way I can buy the threes is if they give me a pricing where the market is not expecting as much as it is pricing in at the moment. I think that will be the opportunity. Whether it's 490 or 501, I don't know. I just know that in this area, the market is giving me a reduced probability of cuts and speed of cuts from late 2024 onwards. And therefore, that is something that I can buy because the speed of cuts might be faster than the one they've priced out. As simple as that. I think 2s, 3s and 5s is the area that I want to buy on a spike higher. I don't want to touch the 10s and 30s. To me, the 10s and 30s have very little value still. I think that they will naturally tend to go up as people sell duration and as the duration supply hits. And therefore, I've said it all. I am looking for a steepening yield curve. So let's have a look at the yield curve and see where the opportunities might be. This is 2s, 10s, and I think the natural level to look for as an opportunity is this 84, 85 level. Now, what is interesting is that the QRA came out on August the 2nd, and this is basically it. This is where we were. We were call it 86, 87 basis points of differential. And since then, we have been in a gradual, slow steepening as people realize that the supply is going to hit the 10-year area, the 30-year area. It's not so much going to hit the 2s. So any kind of retest of that level gives us a very good entry point, because if it starts going through, there's something that that I haven't considered going on, and that your stop can be very, very tight. So this 83 to 85, 86, 87 area is a very good area to put on steepeners. Much the same as in 530s. If we have a look at where the August was, this is right here. It dumped, it came back, because don't forget fives will get hit just, because they have some duration. 530s is probably the cleanest steepener because fives have some duration. So if you're not really playing twos, tens are much more of a the Fed is doing nothing, twos do nothing, and therefore I'm really playing tens, while 530s is a purer curve play. Now I think it's very, very unlikely that we go higher than these levels that we saw around 15. I think I'm going to start adding to my positions here at 12 and do them all the way to 15, because I know that if it goes through 15, there's something going on which I haven't considered, and I can take a very small loss and think again and try to figure out what is going on. But these levels are really beginning to be very interesting for the steepeners and a very good risk-reward level, as I've told you. Why would the curve flatten? Well, the curve would only flatten if the Fed was more aggressive than we expect. I find it very difficult to believe that they're going to move the dot plots for 2023 any higher. What they could do is they could move the dot plots for 2024 and 2025 higher, in which case I will be wrong. I will be wrong on my steepening call, because it's quite possible that we get to these levels, because the market will start pricing in cuts later and fewer, in which case, for a brief period of time, twos and fives area underperforms long duration, because long duration is going to like it. But at some stage when we get up here, then the reverse will happen, because twos and fives will have priced in something which is more bearish than probably will happen, and tens and thirties will be left with nowhere to go but higher in yield. So whichever way round it happens, whether it happens from here or it happens from this area again, I think the steepener is the thing to have. Naturally, it won't be pleasant being stopped out here, but it will give us an even better opportunity at much better levels. So I'm not really worried. I have a little bit of a steepener on. I will add when it gets to here and stop myself out around the 20 area, and then look to put it back on around the 35 to 43 area. I think that is what is most likely to happen over the course of the next couple of weeks. Next week, I think it's more likely that we get some steepening because of the very heavy supply we have in tens and thirties, and therefore I don't expect a test of these levels for next week. After CPI, anything of course is possible, but the likelihood and the odds of CPI being anything but in line are not great. Why should CPI be low or lower than the market expects when oil has been doing what it has been doing over the course of the past month? The market that I think will be far more interesting than treasuries next week is going to be the European bonds. It's quite likely, I think. I mean, I should rephrase that. It's not quite likely. It's I consider it more likely than the market does that they do a hike. And it will probably be the last hike. I think nobody can out-hawk the Fed, and I don't think the ECB is even going to try it. And that's why I think that if they hike, it'll be the last hike. In which case, this 340 area in the Schatz is going to be very, very attractive. And what I think is likely to happen is that the yield curve on the back of it is likely to flatten. So something like Schatz Bunds, 2s, 10s, is likely to go up and test at least these gaps here and this kind of level around 73. That's 20 odd basis points. So what I'm basically saying is that if they do hike, the one thing that you don't want to do is sell bunds. You might want to do 2s, 10s, you might want to do 5s, 10s, but I don't think you want to sell bunds. I think bunds will take it as an opportunity to load up at higher yields if you get that reaction and they stop everybody out above 276. I think you want to buy bunds. The yield curve A should flatten, and B, it's quite possible that the market interprets that A as the last move, but B as the coup de grace to the German economy. We'll have a look later on at what equities are saying, but I really don't see that the risk reward, if they make a quick move up to 280 to stop everyone out, is anything but A, buy calls or call spreads in bunds, or outrights for if you want to play it that way, or look for a flatter yield curve, especially in 2s, 10s. If it gets to about there, I would have thought that the next, it has to flatten, because I really think that bunds are going to be far better bought. Duration there is going to get far better bought than it is A in the US, and B that it is. I just can't see anyone buying Schatz on the back of a hike, because Schatz is going to stabilize somewhere at these higher levels. They're not going to cut straight away after hiking. And even if it's the last hike, okay, where's it going to go? From 340 trade to 320? That's going to be nothing compared to what the bunds can do if they start anticipating a recession in Germany. So I think the flattening trend in Germany as opposed to the US, so that's an interesting trade. Flattener in Germany, steepener in the US. And also what is interesting is to be buying the longer duration stuff in Germany against the US. So let's have a look at the differentials. US, Germany. This is 10s, 10s. I think any kind of a dip is a buy, because I think it's going up with time. But especially interesting is going to be the 30s. If that manages to dip a little bit and stop everyone out who is in this area, who's long in this area, down to here, 151, down to 150, I think it's going to be a very interesting buy for 173. Going back to the 10s, I think any kind of a dip down towards 152, 153, I think we're going to see 173 again. We topped it, topped and tailed it right there. I think any move back down towards 153, I have to be a buyer, given what I'm thinking and what I've just told you. If The yield curve in the US is steepening and it's flattening in Germany. If the supply is all in the US or mostly in the US, and if the German economy is much weaker than the US economy, and I don't think there's much doubt about that given the data, you have to be looking to buy dips in this market. One thing that I've got right over the course of the past several weeks, not that I've made much money out of it, is the direction of the dollar. My logic was right, my execution was chicken-ish, because I'm not really a foreign exchange trader. I don't have much confidence in my foreign exchange calls. But what I think is that any kind of a dip towards 103.5 to slightly below 104 is a real potential to buy some call spreads in the dollar. I think eventually it'll trade up here towards 107, and the reasoning is quite simple. The interest rate differentials in the long end are going to remain and tend to go out towards the 200 area. It's consistent with everything I've told you. The supply, the difference in the economy, the fact that if the ECB hikes, I just can't see them hiking again unless the data comes out and is horrific, which I think is unlikely. So any dip to this around, whatever it is, 103.70 area, as you can see here, I think is going to get bought with both hands, and I certainly want to buy it. It translates to around 108.60 in Euro USD, and I think that that is a wonderful level to put it on as well. Given that I keep on seeing those differentials going out, I think that if the ECB hikes and the dollar panics, for whatever reason, to around this just below 104, I definitely will be buying long-term call spreads. I just can't see any reason to own gold when you're getting a 2% real return in tip, and in the 10-year is basically giving you a 2% real rate of return. Why would you want to buy and hold gold, especially since I don't think duration is going to rally? I just can't see any reason for it. I mean, I'd just avoid this market completely. I just wouldn't trade it. There is absolutely zero reason to believe that it's going to do anything much, because on the one hand, the dollar is strong and going to, I think, get stronger over time as the interest rate differentials go out. The Fed and the ECB and all the central banks, they're probably going to hold rates tight for a long time. Why would you forego earning 2% real to own something that has no yield? Well, only if you're really, really worried that inflation is going to re-accelerate. I don't think there are any signs of that, and therefore I don't see that there are any reasons to own gold. You trade it technically. I think, if you have actually a look at what has been happening here, it's been a very good technical trade, and this thing just, it's been a very nice technical trade. Basically, it stays within the Bollinger Bands, it touches the Bollinger Bands. This is the 200-day moving average. It goes up there, it comes back down. It's just a technical trade. I don't think there is any reason to expect it to trade above the 200-day moving average anytime soon. Simply, if that happened, to me would indicate that something has changed and something that I don't understand is going on. just as if the yield curve in the US flattened above the levels that I indicated to you earlier. It would just indicate that something is going on that I don't understand, and therefore I wouldn't want to have a position either way. I just can't see any hope for gold in the short term. Different story for oil. It's holding the top of the Bollinger Band, and where is it likely to go? I think it's likely to go to around 92 area. And if you have a look, that is precisely the level on the weeklies, just above 92, below 93. That is the area where you no longer want to own oil. And if we actually have a look at DBC, what is that level? That is around just above 26, I would say. Those are the levels that you're going to be looking at. And, if you look at gold DBC, it could easily dip to around these levels, and then that's that. And then you get, a sell-off in the commodity sector, and probably people switch to gold because there's no point in owning commodities anymore. They're not going up anymore. And the fact that I can't see DBC now accelerating is also the reason why I can't see that the Fed is going to need to do more than it says in its dot plots. And therefore the reason why I'm a better buyer of the short end in the US, because I think at some stage the market will just say, well, we've reached the top, we've reached terminal, and actually the economy is probably going to now roll over, and we're going to get disinversion of the yield curve. I've never seen a disinversion of the yield curve which has not led to recession. Could be different this time, always could be different this time, but the odds are it's not. And therefore, once commodities reach this kind of technical level around 26, just a little bit higher than 26, it's no longer time to own them. A few weeks back, when this spread, and this is SPY over Germany, EWG, when it was around these levels, I said that if there's any weakness in the stocks, it should be expressed in this chart, i.e. that Germany and Europe should be leading the way weaker. Now this is SPY EWG and this is SPY over FEZ, the difference being that it's basically the stocks as opposed to just Germany. Much the same kind of chart, you're welcome to try and replicate it here. You can see what this is and you can see what this is. It's not a big difference. I think Germany is more, SPY EWG is more bullish than SPY FEZ. But you can see what has been going on. We've basically moved to a new area, which is very, very pivotal. We have been here and then made big moves both up and down once we've decided what the direction is. I think the direction is going to be up. So what do I think is going to happen? Well, least of all is going to happen to US equities, and most of all is going to happen to European equities, which makes sense and starts to triangulate with what I said about the way that respective bonds would behave. If there's weakness in stocks, it has to be shown in Europe first. But I don't think that Europe is going down very fast. And if you think, I'm just trying to put together what I've just said. If I don't think that Germany itself, i.e. the DAX, is going to collapse, then I can't be looking for a collapse in SPY because I'm looking for this spread to go out. And given that we're still in risk on, that probably means that very slowly over time, over the course of weeks, SPY does much of nothing, while the DAX gets slightly weaker over time. That's my best interpretation of what is going on at the moment. So now that we've looked at the SPY FEZ, SPY EWG, let's have a look at ITOT over government, so the totality of the stock market against the totality of the bond market. This is not a bearish chart, right? I mean, we are getting consolidation at higher levels, and over time we will break them, which is just about what I've been saying about bonds, that I think that once they've made the new highs, that probably will be it. And then the stock market will have the ability to slowly do better than the bond market. I just can't see any alternative to stocks being better bid than long bonds. So let's have a look at SPY over SHY. So basically, SHY is cash, let's call it. So basically over time, over the course of, since the beginning of 2022, when everybody got really bearish, the stock market has returned cash. Okay, this is it. We are at the same level. We are the same as cash, which makes some sense because the stock market should basically give you what cash is giving you during tight periods when there is some inflation and, it's giving you cash returns. Now let's have a look at SPY TLT. Completely different picture. Duration, nobody wants it. They prefer equities to duration. Why? Well, because equities are likely to give you a better real return over time. And that is all there is to it. Why buy 30-year bonds when there's probably more growth and a better return in equities? Unless you're in risk off, unless the economy goes tits up. But it's not doing so at the moment. So there's absolutely no reason to believe that it's going to begin anytime soon. And therefore, these dips in equities are trading opportunities, just like any rip in equity is a trading opportunity. I don't think SPX by itself is going anywhere. So let's have a look at what Europe is saying, because if I'm saying that Europe is going to perform worse than the US, then that is going to tell me what the US is going to do, isn't it? So at the moment, we are getting something which I think is a classic. What did the market do on Friday? It went just below the previous low, stopped everybody out, and boom, straight back into, to the 200 period. 200 day, that is, moving average and above. So what's it going to do now? Well, it's going to stop them all out up here around 4,300 or something and come right back. While the 200-day moving average is still pointing upwards, or sloping upwards rather, it's very unlikely that we maintain these levels. Anything to 41.50 to 41.38, I think, is a great buying opportunity for back up towards these levels. And this is the weakest market, right? If you have a look at the weeklies, it just got to where? It got to beautifully to the bottom of the Bollinger Band and straight back in. It's going to keep on doing this, isn't it? It's just going to keep on doing it. Boom, 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 boom. Eventually, it might break down. But I think we are a long time away from that. And if I'm saying that for Europe, I think I have to say that for the US, don't I? So let's have a look at my clean chart. I really am having great difficulty believing that at the moment, with the data that we have, with the volatility situation that we have, and with the differentials in favor of the US in terms of trading, we are going to bust this 43.84 level in any kind of a hurry. Europe would need to fall apart, or I'm completely wrong in everything that I've told you. Now, could this be, a head and shoulders like, a lot of people are saying? Yeah, of course it could be. But I'm really having difficulty seeing the US market below 43.84, or at worst, this kind of level, 43.30. I think that is support for a continuous amount of squeezes up. I don't think the stock market is going higher, but I don't think it's going lower either. I would much prefer to sell Europe on a spike than to sell SPX on a spike. And really, every time Europe comes down to 43.80, every time SPY comes down to 43.85, I think it's time to think about buying it against Europe. Now, I do want to show you a couple of charts which are saying that one should be cautious about equities. And the first one is ETA, as you know, my favorite ETF. Why should this ETF be weak at the moment? Well, I think there's very little doubt that we are going to be rearming as a world. And which companies are better than Raytheon and Boeing and so on if the world is going to be rearming? I can't think of any. But in any case, ETA is weak. ETA is weak outright, and it's weak against SPY. So this is ETA against SPY. It just about reached the levels that I thought it would reach, and then it has absolutely collapsed down. But I think this gives us an opportunity. I think these levels, just above this line at 107.93, let's call it, mid to high 108s, is going to be a great opportunity to own ETA for the long term. And the other chart that I'm finding very difficult to understand is this one, XLI. XLI is now back down to the levels that we saw in August, really when SPY was down at around 43.50. Is there a distinct possibility that XLI forces the weakness in XLI and ETA, which is part of XLI, right? It's the same kind of sector, forces SPX down? Yes, but it's not a high probability, because I think, when XLI gets to these areas and maybe does an ABC down to this kind of area, 101.70, I will definitely be buying it. And that gives me, that tells me that really SPX, unless the Nasdaq gives up and those big seven, magnificent 7 or 9 or however many there are, give up, SPX will outperform XLI for a period of time still. And if I'm only looking for 3 or 4% down in XLI, I can't really be looking for much more than 2 or 3 for SPX, which tells me that those lower levels below 43.80 to 43.40 are going to hold. So lastly, let's have a look at the Nasdaq to see if that is giving us any signs that it's about to go down hard. Because the only way that SPX can come down as much as XLI and so on is if the Nasdaq allows it. Well, here we are. This is the 200 period moving average. We have converging Bollinger Bands. We have a market which is stuck within very narrow ranges. Absolutely zero sign that this one is about to collapse. The collapse might be down to this kind of area, 14,938, but it's not going to be below these lows where the SPX was in the beginning of August. So triangulating these indices just basically tells me that any kind of weakness we have in the American stock market is going to be of the order of a couple of percent, and really that you are looking to sell spikes in Europe against buying dips in the US. And with that, on to the biases. Well, I think it's fairly clear to you that I am biased towards a steepening yield curve in the US and a flattening yield curve in Germany, and that I'm biased towards buying bonds against selling 10-year notes or 30s. I hope we get that, but we're not going to get it until CPI or CPI, PPI and ECB. The early part of next week, I think the market is going to be pressured, the bond market, by the auctions in 3s and 10s, because I don't think anybody's going to be really that aggressive in the auctions. Why be aggressive at auctions when there's going to be another trillion issued behind what is being issued at the moment, and you have the risk of getting completely buried by a hot CPI number. So I can't see any strength in bonds Monday and Tuesday, and then on Wednesday we see what CPI brings. So the opportunities on Monday and Tuesday to do anything apart from sell spikes are going to be few and far between. But after that, everything will change. And as I told you, I think the real opportunity is going to be playing US-Germany, both on the equity side and on the bond side. Thank you very much indeed. And of course, as soon as I see something differing from what I've just told you, I will tweet it out, and all my trades, of course.